Welcome, ladies and gentlemen, to another edition of Behind the Business. I'm your host, Robere Kazadi. Today, my guest is Zev Nijensohn of Silver Heights Capital. And I'm super happy to spend a little time and talk to Zev about how he got into the industry, what Silver Heights Capital does, your insight about AI and how it's affecting business in real estate specifically. And then we're going to talk about your views, what you see for the future of our industry. So again, thanks, Zev. Thanks for being here.
I'm happy to be here. Thanks for having me. That's
Right
a
on.
mouthful of questions. So you let me know where you want me to start it.
Yeah. Okay, good. So my first question to you, Zev, is just give us a little bit, the short version of your background and how you got to be working with Silver Heights Capital.
So my training ground, and I'm going to age myself a little bit, but this is mid 90s, graduated college, investment banker for a while doing M&A. And then my real training ground was in private equity. So I spent 5 years at a mid-market shop that was doing both buyouts, leverage buyouts, and growth equity. And we were telecom media business services focused. And this is right during the first technology and internet boom, at least in yours and mine life cycles. And everything crashed, as you remember, in 2002. And I jumped over to the public side because I saw a tremendous amount of opportunity in distressed assets and stress assets and things that we just couldn't take advantage of on the private equity side. It might have been kind of a 25-year-old type guy jumping to the next opportunity and what seemed exciting at the time. Retrospectively, I'm not sure I would have done that, but I ended up spending the bulk of my career in the public markets, trading equities and debt across the capital structure of corporates. I ended up at a Goldman Sachs spin hedge fund, started my own fund, ran it for 7 years, sold it to a big bank, and then took some time off and was looking for the next opportunity and really didn't want to deal anymore with the volatility of the public markets and with security selection in an environment that had moved far away from fundamentals post the great financial crisis. The business that I'm in right now, which is real estate lending, and I'll give you more background on it, is much lower volatility, double-digit yields, very little principal risk, and probably better suited to someone with gray hair. And that hedge fund world and the public security world is a younger man's business. You can't have seen one or two cycles and actually be good at that anymore, I don't think. Just, too much.
Right. So the hedge fund that you started, you said it was acquired and it was acquired by BNY Mellon. Is that right?
Exactly.
Awesome. How was that exit? Was it very smooth? And I guess it lived up to everything, all of your expectations.
It actually, the idea was to take something that was performing well and wasn't very well scaled and plug it into the wealth management business at Bank of New York Mellon. I mean, that was the general thesis. We had products that were tailored, almost custom tailored to that kind of client set. And yet it worked, and it was working pretty well. I got sick 3-4 years into it, and we had to shut the whole thing down. I had to take 2 or 3 years of medical leave. So I'm not sure what would have become in the business and how it would have grown under the bank if that wouldn't have happened. But it was a good exit from that standpoint. The strategic combination made sense.
Right. Well, you look great. So I guess the recovery was smooth, and
Still
glad
very
you're
cool.
doing well.
Yeah.
So with regards to the private funding that you guys do now at Silver Heights, do you Do you have all of the money yourself in-house, or do you third party this out to a different money provider at the end of the day? Are you a broker or are you the end source?
So there's a lot of different models. There are guys that just originate. There are guys that buy loans from originators and hold them on balance sheet. There's guys that just do servicing. We're a full cycle shop. So in some respects, we're a lender, meaning we're originating and servicing loans, but we're also an asset manager because we hold everything on balance sheet. And one of the big differentiators between what we do and what some of the more origination centric models do is we've got the capital. So when we put out a term sheet, we close, we've got the money that's behind us. We're never out there welching on deals like a lot of these guys tend to do. And it's an interesting business because it used to be owned by commercial banks. And that changed dramatically post the financial crisis, regulatory restrictions more than anything, whether it was Basel III, if you've heard of that term at the global level. And then the US regulatory bodies put pretty severe restrictions around what they call high volatility commercial real estate. So construction lending and significant renovation lending and anything that doesn't have pure cash flow tied to it got a pretty big capital hit. So where you used to have, I don't know, 10 cents on the dollar of equity for a loan that you put out for a construction loan, now banks need to reserve 12 or 15 or 17 cents. And it became much less profitable for them to do this kind of lending. And that opened up the floodgates for firms like us to come in and fill the void. And
I get it.
that's basically the story of private credit. Private credit, very topical right now because there's a potential blow up risk due to software and corporates and other investment. But it was banks stepping out of the C&I space for certain reasons that opened it up to guys that look like us on the private side.
Got it. Got it. And that's actually kind of leads me to a little question that I have down the road, but we'll get back to that. So Silver Heights was founded in 2016, right?
So it was
And
founded before that in a different iteration. So the origin story of Silver Heights was actually development. And it was one guy, one of the founders, that started developing office buildings and apartment complexes on a one-off basis, and then started lending a little bit to some of the builders and developers that he was working with. And we came to the conclusion, or the firm came to the conclusion, that it was a much better business to be on the lending side than to be on the developing side. So in 2016, we started exclusively lending under this platform, which is Silver Heights.
okay, right. And since 2016, you guys have closed over $900 million of funding.
Yeah,
And
I think we're
my
at $1 billion.
research says,
Yeah.
yeah, almost $1 billion over 330 deals. There's a lot of money out there. So, given your background and the multiple things that you've done in the financial industry, what was it specifically about Silver Heights that drew you to this opportunity?
I don't think me looking for an opportunity is probably much different than yours. You look for certain characteristics, one being inefficiency, one being a business model that's got some stability to it and duration. So we charge 12, 13%. That's the general rate that we get. We charge points up front. We get extension fees. It's a model where there's a fair bit of income that gets generated per loan. You never want to step into something like that if it's at the precipice of getting tight and losing some of those economics. And this is a business that's incredibly logistically intensive. And that's what creates the inefficiency, and that's what creates the moat, the barrier, whatever you want to call it. You know, you go to business school, you'll hear 6 different terms for the special sauce or the moat, or what keeps things, what keeps that duration intact. Here, it's that logistics piece of it, which is what we do is it easy to understand. You need a construction loan, you want to go and build an apartment building, we get you the money, right? But if you think about what it actually takes to do the diligence on that, to figure out the budget, the construction costs, to delve out money based on milestones, to manage all those cash flows, and more than anything, to manage the relationship with a builder or developer. This is not a Wall Street guy. They're not sophisticated in that, financial sense. These are street guys, blue collar guys that might be worth tons of money and might be building, hundreds of millions of dollars or billions of dollars worth of stuff. But
Absolutely.
it's a
Absolutely.
different mentality than dealing with a banker type or someone that came out of a Wall Street type background.
Right. All right. So private credit, real estate lending are deeply relationship and judgment driven businesses. Would we agree?
The way we do it, they are. And there are folks that look like us that have taken a model and made it more algorithmic. And just since we're talking about it right now, your Google feed or your Instagram feed is probably going to start sending you stuff. Get a loan in 12 hours, plug in a little bit
Oh,
of
yeah.
information, we'll finance you tomorrow. Those are algorithmic models that are basically making a bet on a core set of metrics that are going to stay, that'll be fairly deterministic of how a loan's going to perform. And we could talk about that, and we could talk about why ultimately that fails. But we're the opposite of that. We call it a almost consultative investment banker approach to being a lender as well. So we have very tight relationship with our borrowers, and we play, well, it's a very high touch service model. And again, we try to play advisor as much as we play.
Love it. So listen, we all know that AI is not only the present, but the future. And companies are integrating AI in many different ways.
Yeah.
And this conversation is about that as well. It's fantastic to hear who Silver Heights really is and what they do. But at the end of the day, much of the focus of this particular podcast is to understand how you guys are implementing AI into your business to solve challenges. How are you doing it? So, where are you seeing the most meaningful opportunities to layer in AI without losing the human edge?
It's topical, obviously, because everyone is thinking about this question. It is probably, I wouldn't say most necessary or one of the most necessary things that we're doing, but any business that has inefficiency that can potentially be solved, resolved, refined, accelerated with a technological edge, whether it be AI or something else, that's a massive risk factor. So we look at AI as an opportunity. We also look at the risk that eventually someone's going to come along and come up with one of these algorithms using probably much more information than the current algorithms use that might be able to replace some of that logistical intensivity. And when they do that, or when the industry does that, rates are going to come down. Things just get more efficient. And when you take out logistics, it's just easier to fund on a serial type basis, right? So
Okay.
that's the backdrop. Like, is there the possibility to use AI? In AI, I think of the LLM models and now the applications that are being built on top of those, which is that's agentic AI and much more powerful in a sense than what the actual LLMs are doing and how people are using them. Is there a way to algorithmically create a human underwriter where you eventually can computerize, digitize, whatever you want to call it, the things that you and I are talking about? When you look into somebody's eyes, when you understand their real business, when you deal with them on a day-to-day basis and keep in close touch with them, was there something that the computer ultimately is going to be able to do because it becomes so smart based on the data that ultimately gets fed to it, right? Like if you think about, and I'm all over the map on this, but if you think about Google's model originally was, we're just going to create a search engine. But
Right.
eventually what they figured out and where the value was was they were capturing data on everything that we were doing online. And they probably have massive data centers underneath the desert in Nevada. Maybe they're using some of that data. Maybe they're only using 10% of it, but they know now and can predict what you and I will do after 3 clicks in the Google app, right?
Right.
That's the whole concept. Is there going to be something that somebody creates that's going to be able to underwrite a loan using that same kind of framework on a much more developed standpoint because the technology's gotten better. And because AI is powerful enough to take not just clicks of people buying shit on Amazon, but a much more expansive, whether it be underwriting a loan or underwriting an equity or a piece of corporate debt. Eventually, everything that we do has an algorithm to it. Everything possibly can be digitized, and maybe the technology is good enough that that's going to come along. So, again, that's the context, and that's where the future is going to be. I would consider us to be in the first inning of getting to the end of that game, which is we're using AI. Everybody's using it in the organization the way probably most people in the corporate world are, which is we're using ChatGPT, we're using Claude, we're asking it to help us with making communications easier and more efficient. We're using it for a lot of the kind of search and analytics around search that we would have done for operational things. We want to find out about new laws that were put into place or new regulations put into place for GPLP funds. Now, everything through ChatGPT or Claude, all those questions and answers can be done a lot quicker. We're using it to replace a lot of the legal work in some cases. I don't have to call a lawyer anymore when I can ask Claude or ChatGPT a question, and I get 99% of the answer and probably 150% of the answer relative to what I would have gotten from a lawyer. So
Exactly.
that's
So
how we're using it today. We're starting very, very slowly to implement that application layer on top of the LLMs. So the first use case for us is just workflow management. So we have a process that we use to do construction draws, for example, where we've got one guy that talks to the developer, the builder, and talks to the third-party engineering firm that we use to check on budgets and to make sure that milestones are in place to actually put capital out the door. And that requires 6 different human touch points and call it 15 or 20 different documents or pieces of collateral that need to be checked and refined and signed. And we're creating an application, or we've created an application that automates a whole lot of that. So we are in
do
the
you have a tech
process.
do you have a tech department that is now using AI and developing these workflows for you, or is it left to each of the individual partners to kind of uh, research it on their own and implement whatever is necessary for their workflow?
Yes and
How are you
yes.
guys approaching it? Yes
We're
and
just,
yes, all of
you're
the
going to
above.
find what we're not. This isn't Salesforce with 10,000 employees. We've got, I think 13, 14 employees, and our day job takes up 99% of our time. And we're running hard to originate loans and to close on loans. And we're doing about $70 million of loans a quarter. So, and that's broken up probably into 5 deals. And there's, like I said, it's logistically intensive. So when you've got 13 people running really hard, it's very difficult to dedicate a full-time resource to go and figure this out. So it's happening from the top down and from the bottom up, and we haven't figured out yet exactly how to optimize that whole process.
Got you. Got you. Okay. So, from a business development side specifically, how is AI changing the way you identify, qualify, and nurture borrower relationships?
It's not yet, but it will within the next quarter or two. And we've actually, and this answers one of your prior questions, but we've hired, called an outsourced consulting firm to help us think through those exact issues, which is most of our loans right now, and probably will in the future, come in through, we've got a fairly proprietary network, 60% repeat borrowers in the portfolio. It's the builders, developers, lawyers, the entire ecosystem around a loan that we've gotten to know over the last, call it 10, 12 years. Those are the guys that are feeding us most of the opportunities. So it's not like we need yet to have a computer or an AI that's going out there and doing outreach to go and create more origination. For us, it's more the after a loan comes in the door, how do we automate process?
Pipeline management, ultimately, right?
Yeah,
Yeah.
and
Okay.
efficiency. Like we
I'm
don't
sorry,
want
say
to
that.
add we efficiency because we have. If you think about the people in our firm, of the 13 or 14 people, 70% of them are accounting and back office folks. That speaks to the logistics and the intensive nature of the logistics of a loan. In order for us to go from 500 million under management to a billion, we don't want to go to 26 heads from 13. But the way we're set up right now, that's exactly what we would have to do.
Got you. Got you. Got you. So the implementation of AI will ultimately allow you to be more efficient, and in which case you'll be able to do more business with the same amount of people and hopefully make a greater profit for the company.
And with less risk, because there's key man
Yeah,
risk right now. There's
right.
guys or gals or people in the organization that own a certain piece of whatever our process is. And if they, God forbid, go on vacation for an extended period of time or something happens, somebody else has to pick up that slack, relearn or learn that process, plug themselves in. There's operational risk that I think can be pretty severely mitigated by application of some of these technologies that are coming down the pipe.
Okay. You may have answered this question already, but I'm going to pose it again. And if you think of something else you'd like to say in response, let's work with that. So, what's a use case for AI in the real estate lending world that you think is underappreciated or underutilized right now that most firms should be paying attention to?
The easiest one is the one that I mentioned, which is legal. We spend a lot of money on internal and external legal work. What the AI can do today, and that's not next gen applications, that's not next gen anything. What even ChatGPT can do from a legal standpoint is extraordinary. It can reduce
It's
your legal
amazing.
cost by 80%.
Right. Right. Absolutely.
And
Um, uh,
it's not just the cost, it's also the democratization of understanding some of these legal technicalities and operational technicalities. Because now that people have access to, everybody learns and thinks in a different way. But when you have your own AI whiteboard, you can plug in a document, you can ask it whatever questions you want. You don't have to feel stupid about it. You don't have to be silly. You're not using anybody else's time. It's an incredible tool. And we tell our younger guys, spend the time to do it. I'm going to give you a whole bunch of documents. You don't even need to read them anymore. Plug it into the AI, tell it what's salient out of it, and understand beyond just the base level what it is that we're doing and what matters. And by doing that, you're going to get better at the business, not just at that little key element of what you're doing, but as a learning and teaching tool, it's incredible.
well, and not only that, but you can do it in your pajamas.
You can do it in your car. I
That's
spend
right.
most of my time when I'm commuting talking to ChatGPT about something.
Yeah, it's an amazing tool, obviously. Okay, let's kind of shift and start looking at the future of the industry. As you've mentioned, banks have been pulling back significantly from construction and bridge lending in the recent years, which has benefited alternative lenders like Silver Heights. Do you see that dynamic as structural and long term, or do you expect banks to re-enter the space aggressively as conditions normalize?
So interesting enough, the answer to that is yes. And banks haven't necessarily pulled out of the space. They've just changed the way that they create exposure to the space. So
Okay.
what we're seeing a lot of is banks, rather than doing individual loans, and having all the infrastructure that you need to do that, the underwriters, the servicers, everything in between, the accounting folks, they are backing guys like us with capital. And they're creating pools where they attach at a much lower point, meaning typical construction loan, let's say, is at 65 LTV, 65 cents on the dollar. A bank could either hold that on its balance sheet, or they could do a pool of loans that we manage for them, a fund of one, call it, for a bank, where they attach at 50 cents on the dollar, 40 cents on the dollar. And they get very similar, if not better, economics on that pool, which with much better risk, and with much better risk weighting on their capital, meaning they get a higher return on their equity than they do for individual loans. And we're seeing that movement, which benefits us, which benefits them, and which basically just kind of shifts around capital into different buckets, rather than takes it out of one hand and puts it into another. Does that make sense?
Does I
Let's
think
let's
it
say
was
Bank of America used to do $1 billion in a certain region of CRE loans, right? Split into 10 different loans, $100 million construction loans. Now Bank of America can give us $1 billion, or can give a firm that looks like us $1 billion. We'll put $1 billion into it as well. And their $1 billion is, they're investing in a pool of loans rather than individual loans. And rather than have
less
and
risk.
if you think about, well, less risky because they attach at a lower rate. So their cushion, if those loans go bad, is greater. That's the easiest way to think about it. And from an operational standpoint, they need 2 people instead of 100. Because they're making an investment in us. They're letting us do all the heavy lifting. They're getting the same return. They no longer need the underwriter. They no longer need the servicer. They no longer need all those accounting folks. They no longer have to have cash flows going back and forth. They're just investing in a fund, basically.
Got it. So with interest rates and construction costs and housing supply all in flux, what do you think the next 5 years looks like as for builders and developers, and as an extension for lenders like yourself?
Well, builders and developers, if you ask them, have never seen a deal that they didn't like, and it's always up and to the right. That's one of the reasons why we always have a business, because demand, either in good times or in bad, seems to be somewhat inelastic. Notwithstanding like a COVID downturn, or a 2002 or a 2007, 2008. The market right now, if you just think about single family and multifamily housing, so housing units for families and individuals, we're structurally short. That's not a secret. Somewhere in the range of 2 to 4 million homes across the United States, and it's different region by region by region. And by the way, real estate's a regional business, always has been. Austin right now, Austin, Texas could be oversupplied, but New Haven, Connecticut could be very short housing. So you need to think about it. It's very difficult to think at a national context. Regional matters much more than that. But yeah, nationally, we're short 2 to 4 million homes. There's been an incredible slowdown in kinetic activity, meaning homes exchanging hands. And that's for obvious reasons, which is mortgage rates went from 2 to 7 or 8. Affordability decreased dramatically. People don't want to give up cheap debt, so they're not moving as much. They're not trading houses as much. And everything is just kind of stopped. Not stopped, but slowed down materially from where it was 3 or 4 years ago. That's against the backdrop of a 10-year cycle based on everything that happened in the economy, where construction just wasn't keeping pace with demand.
Right. And you couldn't go wrong as a builder. You just had to get it built and it would sell. Boom, like that.
Yeah, and now there's still certain markets where that's the case. There's certain markets that have been overbuilt, but generally we're still short. So you'll see demographic shift. You'll see people move to where it's cheaper to buy homes, because people need to live somewhere. And
Right.
you see it. You see people moving out of blue states, moving to red states. Some of that's been overdone. Some of that isn't overdone yet. It shifts based on the geography. a couple years of Tennessee being hot, then it gets overbuilt. A couple years of Texas being hot, certain areas get overbuilt. You see the same thing in Florida. You saw the same thing in Phoenix. Northeast, there are areas of the country that are just structurally undersupplied and difficult to build. And those are the best places to lend to. Make sense?
Yeah, it does.
Yeah, if you can't put up easily a new multifamily unit in Philadelphia, but people are screaming for units, great place to lend.
Right. Okay, very good. I've got two more questions for you.
Yeah.
And this next question, if you could give just one piece of advice to a real estate developer navigating this market cycle, someone trying to decide between traditional bank financing and private credit solutions, what would you tell them?
For what we do, which is transitional loans, meaning these are not typically properties that are cash flowing or cash flowing at their full stabilized level. The rate differential between traditional financing and what we do is it's something that you're going to pay attention to, or the first thing you're going to pay attention to, but probably the last thing you should be paying attention to. What matters much more is execution and certainty of capital, because ultimately shit goes wrong. So you're going to build a house. I don't care if it's a fix and flip. I don't care if it's a $25 million house in Greenwich, or you're going to build an apartment complex or a condo complex. Something's going to happen. Construction costs are going to go up. Labor is going to get tight. Zoning is going to create a delay for you. It's going to rain. It's going to snow. You're going to dig where you thought you weren't going to find anything, and you're going to find a fucking river underground. That shit happens. And if you don't have a partner that can work with you, that is going to, at least under certain boundaries of things making sense economically, is going to make sure that you've got the money that you need, can change terms, can be flexible with terms, can work with you. If you don't have that, you're going to fail ultimately.
So you're saying at the end of the day that working with a private funder like yourself or like Silver Heights is that you guys are able to be more flexible than your average bank that's going to give you a loan. Personally, I've lost more great deals at the bank. At the end of the day, they drag their feet, or they require too much documentation, or at the end of the day, they can't even see the value of the project because it doesn't fit into the cookie cutter model that they typically loan.
And God forbid you're already a borrower and you have
Right.
properties that they've cross collateralized and they have an exposure limit that they can take to you. And you
Yeah.
think that they're your partner, you find a good opportunity, you want to close on it because it's competitive like everything else is. And you go to your guy and you say, hey, I need X amount of money to close on this. This is wonderful. Let me show you the business model. And then they go and they say, we can't be your partner on this one for any number of reasons. And
Yeah.
then what do you do?
Yeah, I'm telling you, I've been in this position and it is so frustrating. And I wish I'd known a guy like you back then when I was doing all this construction, but
So you
that's
want to you
another
want a
story.
partner, and the second piece of advice, which is a corollary to it or an adjunct to it, is communicate. This is like it's like a marriage. It's like any kind of relationship. You can have it. The partnership is only as good as the information that you're feeding into it. So if you happen to find a partner like Silver Heights, the more communication you have, whether things are going bad or whether things are going good, it just allows everybody to react with full information. As a hedge fund investor, when I ran my own fund, we always said, I can trade around any environment as long as I've got good information. I don't care if it's good. I
Sure.
don't care if it's bad. I'll make a
Right.
decision one way or another. It's the gap in information that lends to most people just saying risk off, can't do it, not going to touch it.
Right. So with Silver Heights, you may pay a little bit more for the money, but you're going to get a partner that is much much easier to deal with, provided and
Yeah,
wants to communicate. versus these big financial institutions, these banks that they're so hardline and stiff. You know what I mean? If your deal doesn't fit perfectly into their little cookie cutter, then it's just not going to fly. So that's interesting. I like that. I like that
We're
whole
also
idea.
incredibly upfront from the very beginning. So if when we get a new borrower, somebody that we don't know, we lay out exactly what it is that we're going to be looking for, exactly the boxes that need to get checked, and where there's flexibility, and where there's movement, and what and how the relationship is going to go going forward. That we spend a lot of time talking about that before we put out a term sheet. So I think our funding rate, once we put out a term sheet, unless there's fraud or unless diligence doesn't check out well, is 100%.
Wow, that's pretty good.
Yeah,
Nothing wrong with
meaning
100%.
once we've actually put name signed on the dotted line, we expect to close and we've got the capital.
Awesome. Um, so first of all, thanks. Thanks for spending some
Well,
time and talking me through this and um, letting us understand a little bit more about who you guys are, how you guys are doing it, and your thoughts on the future of the business. One last question. Is there anything that I have not asked you that you'd like to touch on briefly? Is there anything else you'd like to say?
there are there's so many different ways to make money, and there's so many different ways to invest. Anybody that's out there that's either looking to make an investment or looking to borrow money, this is third grade stuff that you would tell your kids, but you need to think about that risk versus reward. Risk, if you're borrowing money, you need to think about those risks of how that money actually might come to you or might not come to you, might get taken from you. It's not just dollars and cents. You got to pay attention. And this I learned in private equity. We would do a private equity deal. We would spend, in terms of time allotment, 30% of our time diligencing the opportunity, winning the opportunity, 70% of the time on the structural and legal framework to make sure if things went bad once we funded, that we were protected or somewhat protected. And everything that you do in life, and especially in this business, whether it's development or whether it's borrowing for development or lending for development, I think follows that same kind of model.
Awesome. That's a great way to wrap it up. All right. Thank you very much, everybody. Thanks for tuning in. Again, my name is Robere Kazadi, and today my guest is Nijensohn and Silver Creek or Silver Heights Capital.
All
Sorry.
right.
Yeah. And wow, what a pleasure it was to speak with you. And we'll see you on the next one. Thanks again, Zev.
I appreciate it, Robert. This was a good time.